Hey, Market Decoder here. Something unusual is happening in the financial markets right now, and most people aren't seeing the full picture. While headlines talk about stability, the data shows rising stress across multiple asset classes at the same time. Liquidity is tightening, leverage is being forced out, and the next 48 hours could decide the direction of global markets for the coming months. Let's start with what just happened. Over the past few days, exchanges have quietly increased margin requirements across multiple futures markets. The cost of holding leveraged positions is rising fast. When margins increase, traders need more capital to keep their positions open. And when they cannot provide that capital, positions get liquidated automatically. That creates forced selling, not emotional selling, not fundamental selling, mechanical selling. We are now seeing the early signs of that process. Gold volatility has surged. Silver has experienced extreme price swings. Commodity futures are showing unusual pressure. And at the same time, liquidity indicators across global markets are tightening. This combination rarely happens without consequences. But here's where things get even more interesting. While paper markets show weakness, physical demand is telling a completely different story. Dealers are reporting unusually high demand for physical metals. Supply chains remain tight. Delivery times are increasing. Premiums are rising in multiple regions. When physical demand rises while paper prices fall, it signals a structural disconnect inside the market. And historically, these disconnects do not last forever. Either physical prices eventually fall to match paper markets, or paper markets snap back toward physical demand. One of these realities always wins. The question is, which one wins this time? Now let's connect this to the broader macro environment. Global interest rates remain elevated compared to recent years. Central banks are trying to control inflation while also preventing economic slowdown. This creates policy tension. When financial conditions tighten too much, markets react violently. When liquidity increases too quickly, inflation returns. Policymakers are trapped between two risks, and markets are starting to price in that uncertainty. Bond yields remain volatile. Currency markets are showing instability. The US dollar has experienced strong moves in short periods. Equity markets are reacting sharply to every economic data release. This level of sensitivity tells us the system is fragile, and fragile systems break under pressure. Now let's talk about risk assets. Bitcoin and crypto markets are also at critical levels. Historically, crypto acts as a liquidity indicator. When liquidity increases, crypto rises. When liquidity disappears, crypto falls rapidly. Current price action shows hesitation. Buyers are cautious. Momentum is weakening. If key support levels fail, we could see accelerated selling across the entire risk spectrum. That matters because modern markets are interconnected. When one asset class falls sharply, leverage unwinds everywhere. Stocks, commodities, crypto, bonds, everything becomes linked through liquidity. Now, here's what I'm watching next. Asian markets will open first. They often set the tone for global trading. If Asian markets show strength, risk sentiment stabilizes. If they show weakness, selling pressure spreads to Europe and then to US markets. This chain reaction has repeated many times in previous crises. At the same time, geopolitical uncertainty continues to rise. Global tensions increase demand for safe haven assets like gold, while also creating panic selling in risk assets. These opposing forces create extreme volatility. So what happens next? There are two possible scenarios. First, the bearish scenario. Rising margin requirements force more liquidations. Liquidity continues tightening. Risk assets decline further. Volatility increases. Traders sell assets simply to raise cash. In this environment, prices fall regardless of long-term fundamentals. We have seen this before during major financial stress events. Second, the bullish scenario. Physical demand remains strong. Forced selling eventually exhausts itself. Liquidity stabilizes. Markets recover sharply after the panic phase. When leverage gets flushed out of the system, strong recoveries often follow. History shows both outcomes are possible. The key factor is whether liquidity conditions improve or deteriorate from here, and this brings us to the most important point. Markets are currently driven less by fundamentals and more by liquidity mechanics. Margin requirements, leverage levels, and capital flows are moving prices faster than traditional supply and demand. Understanding this dynamic is critical for anyone participating in financial markets today, because volatility without preparation destroys capital. If you are trading short-term, you must manage risk carefully. If you are investing long-term, you must understand the macro environment. Every strategy requires clarity, discipline, and a clear time horizon. Do not follow hype. Do not follow fear. Follow data. Over the next few sessions, we will see whether this is simply temporary stress or the beginning of a larger market shift. Watch liquidity indicators. Watch market reactions to policy decisions. Watch how risk assets behave under pressure. The market is sending signals. The question is, are you listening? Stay sharp, study the data, and always make decisions based on logic, not emotion. Market Decode.